This is today's Daily Market Comment at XM.com by Haralabos Pisuros. I'm Christina Marujos. Equities finished the first trading day of this year's final quarter on a positive note, with all three of Wall Street's main indices gaining more than 2%, as Treasury yields pulled back on the larger-than-expected slide in the ISM Manufacturing PMI. Oddly enough, it seems that negative U.S. economic releases are now having a positive effect on equities, as they may be a reason for Fed officials to slow down their future rate increases. Thus, more data suggesting deeper than expected economic wounds may result in a similar market reaction. A potentially strong U.S. jobs report on Friday and hawkish remarks by Fed officials who are scheduled to speak ahead of the release could revive expectations of more aggressive tightening and thereby bring equities back under renewed selling interest. In the FX world, the US dollar traded on the back foot against most its major peers, with the pound being among the currencies that took great advantage of the greenback's retreat. The British currency extended its stellar recovery, and what added extra fuel to the advance were reports of a U-turn by the government on the matter of abandoning the top rate of income tax. However, with the UK PMI suggesting the economy contracted during Q3, the nation may be approaching a state of a recession, and with the Bank of England expected to tighten even more aggressively at upcoming meetings, pound traders may not be that excited. The Reserve Bank of Australia decided to slow its pace of tightening, raising rates by 25 basis points, but officials left the door open to more increases. The Australian dollar fell at the time of the decision, with its traders adjusting their rate path projections, anticipating only another 100 basis points of increases, with the peak expected to be reached in June. The central bank torch will now be passed to the Reserve Bank of New Zealand, which decides on rates during the Asian session on Wednesday, with investors fully pricing in a 50 basis points hike. The spotlight may fall on the bank's forward guidance, and anything suggesting it may slow down its future path could add pressure to the Kiwi. Oil prices gained nearly 3% yesterday, aided by reports that the OPEC Plus group is considering output cuts of more than 1 million barrels per day, while gold earned around 2.5%, extending its advance today, perhaps boosted by the dip in the US dollar and the pullback in bond yields. With the US 10-year Treasury benchmark yield falling to a more than one-week low, traders may have temporarily fled to zero-yielding assets like gold. This was a Daily Market Comment. Thank you for watching at XM.com.